Hello and Namaskar traders. The credit for this video goes to Prakash Radhakrishnan and Code Learner, who had requested me that if possible, if you please do a video on the indicator settings that I currently use on my charts. An indicator settings video is much awaited. So Mr. Prakash and Code Learner, I'll take this opportunity to create this video wherein I'm going to talk about indicators. What indicators am I using on my charts and what purpose do they serve? So let's take it up. Before we go to directly on my charts and what are these indicators, etc., I would like to explain the concept of indicators a little bit in detail, because indicators are that section of technical analysis which is, I believe, is misunderstood the most. So I have created a mind note, and hopefully this will help both of us to understand the concept of indicators and how to implement them. So which indicators I use and why? There'll be three sections to this which we will discuss step by step. The first is the yellow one, which is what is an indicator and why use them at all. So indicators helps us towards objective analysis and makes decision making easier. So let's try and understand. When we take a look at a chart, we are trying to analyze the chart. And let's say you find some kind of a pattern. Let's say left shoulder, head, right shoulder, something like a pattern. Now this pattern recognition is based out of certain rules. But then if we give the same chart to 10 different technical analysts, very likely few will disagree and they will come up with their own views that it doesn't look like a very good head and shoulder top or some pattern. What I'm trying to explain here is there is a certain degree of subjectivity involved in visual analysis. This is visual analysis. There is a certain set of rules, but essentially it's a visual analysis. On the other hand, when it's about indicators, especially when you're looking at some indicator which has a proper formula behind it, then essentially it's a number. And to the decimal point, if the calculation is done as per the formula, the number will be same for everyone. So it makes life easier and it's clearly very objective driven. A very lame example would be something like RSI 14 below 30 means oversold. So a 14 period RSI has a certain formula behind it, and if calculated and plotted, if that particular value of the indicator falls below 30, then it is understood or assumed that it is oversold. So it's very clear. There is no subjectivity in it that someone will say, no, this is not oversold. As per the formula, as per the rule, it is oversold. So that helps for a decision maker to kind of break down what is the state of that particular indicator. Now, all right. Now, there are two things that a particular indicator does for us. Number one, it helps us to confirm, and it also helps us to alert. Now, to confirm is a lagging aspect, and this is where all the lagging indicators come into play, like the moving averages. On the other hand, to alert is essentially the leading indicators, which is trying to give us the information before the event has even happened, something like a momentum indicator. Now, when I take classes, I generally take a very silly example here to explain to my students that what do I mean by confirm and to alert. Now, the example that I take is, let's say you see dark clouds in the sky, okay? And you know, based on your past experience, whatever your age is, you know that it's going to rain. So the dark clouds that I see outside is an alert that it might rain. Now, I don't know whether it's actually going to rain or not, how much it's going to rain, how long will that rain last, and my plans to go out with my friends in the evening, should I postpone it or cancel it? Should I wear my new leather shoes or not? So it's an alert. It's a probability of a event. And so in technical analysis also, there are certain leading indicators which helps us to alert that something may happen. There is a probability behind it. And of course, it doesn't happen all the time. Every time we see a dark cloud does not necessarily mean that it will rain or it will heavily rain, right? On the other hand, then when you take a look at the confirmation part, that is the lagging indicators, in this case, let's say when it actually starts to rain, and when I can touch the rain, I can see it, I can hear that it's raining, it's a confirmation that yes, it is raining. So it happens post. The event has happened, it's like a confirmation. It is happening or happened. So is it useful? Very obviously, our mind will say that what's the point of having something which is lacking, an information which is late, which has already happened, and now you're telling me it's happening. What's the point of it? On the other hand, leading indicators is something which is trying to tell us before the event. So there is a certain element of value in it. Not necessary. In fact, it's a combination of lagging and leading, and to know when to use which one gives more value to the analysis of your charts. For example, when it comes to understanding the underlying trend of the market, I feel lagging indicators like a moving average does a pretty simple job. It gets the job done in a very simple manner. So we'll look into it. Now let's come to this section wherein I am suggesting that now it's up to you to choose which indicators you wish to use. Now, if you have no clue what are the different types of indicators, then I've taken the liberty to kind of break it down based on whatever little understanding I have. So you can have a trend indicator which helps you to understand the trend of the market, whether the market is trending or that particular chart is trending up, down, or it's not trending at all. The momentum, the underlying momentum of the rise or the fall is a leading indication. It's important. In fact, it's very important if you're a short-term trader. Volatility. This is a term which is generally not liked. People say the volatility of the market is higher, etc. But very important, again, from a short-term trading point of view, extremely important. Sentiment. Now, the first three, trend, underlying momentum, and volatility, according to my basic understanding, are very important, crucial from a trader's perspective. He or she may not focus so much onto sentiment, volume, or the relative strength, but the first three are very important. Now, the fourth one is sentiment. Sentiment plays a very important role, and from a longer, larger perspective. You would have noticed that even a very good, strong, positive news does not lead to much of a positive impact if the market, if the overall situation is down and it's in a very strong bear market. And vice versa, you'll see that in a strong uptrends also. When the markets are in a very strong uptrend, even negative news does not matter too much. It's like a knee-jerk reaction, and the very next day the market bounces back. So sentiment plays an important role. Volume, yes, volume also, especially if you're in the cash market and you're looking at medium-term to long-term analysis, volumes definitely will play a role. And then relative strength. So let's take a look at trend. Trend essentially are something like your moving averages. There are various indicators which tries to get that job done. Is what is the trend of the market. Moving averages. I like to use exponential moving averages. It's pretty good. Momentum, you can use something like an ROC, RSI, momentum indicator itself, Williams percentage R. There are various momentum indicators. Volatility, you can use something like a standard deviation, which means something like Bollinger Band. Keltner channel can also be useful, or average true range. Sentiment would be advanced decline ratio, and you can use the VIX indicator. When you see that the advanced decline ratio are quite extreme at one end, it clearly suggests that the sentiment of the market is skewed towards either extreme bullishness or extreme bearishness. Volumes, you can look at the volume bars, you can plot some averages on the volume bars, OBV and various other indicators to give you an understanding that with this price trend, whether the support of the volumes are there or not. And then finally, relative strength. Relative strength, you can plot ratio charts, you can find how, let's say, one asset class is doing vis-a-vis the other asset class, or how one sector is performing vis-a-vis the benchmark index, how one stock is performing vis-a-vis its peers, let's say in Indian equity market perspective. We can check, let's say, how Nifty is doing vis-a-vis the dollar, how the banking sector is doing vis-a-vis the Nifty, how, let's say, ICICI Bank is doing vis-a-vis HDFC Bank. So one can create ratio charts and do that. And there is the relative strength comparison. It's a very simple indicator which tells you whether that particular stock over a certain span of time is outperforming the benchmark or underperforming. This helps because for long trades, for trades where you buy first and you sell later, it's always good to take positions in those sectors and those stocks which are in a strong mode. That is, they are outperforming the benchmark, and vice versa. So this was a little bit of brief about what is an indicator. We can actually spend hours talking about it because indicators as a segment of the subject is vast. It's ever growing, ever expanding. You and me can sit down and think of a formula and can create indicators, and I've done that in the past also. So this particular vertical is ever expanding. Now let's come to the core. That is, now to what am I using on my charts? So let's come to my charts and you'll see that I essentially use exponential moving averages, and the colors at times change. I like to play around with the colors and the look and feel, that's why. But most of the time you'll find that on my charts there will be a set of exponential moving averages. There will be a little bit of volumes, an RSI, and my all important ATR with standard deviation. Now let's take a look at it. So what I'm using over here are the first three key elements. I like to call them elements. The element of trend, the element of the underlying momentum of that move, and of course, what kind of a state is it? Is it in a volatile state or in a quiet, non-volatile state? So these three I feel are extremely important from a short-term trading point of view. All six are important, but to pick up short-term moves, momentum plays an extremely important role. First, volatility takes the second most important role, and trend, of course, I would say is extremely important, especially if you are a pullback trader like me. So what am I using for trend? For trend, I'm looking at two sets of exponential moving averages. If you have done any kind of a course with me or program, you'll know I use triple moving averages like 13, 21, 34. And you can, I do share this in the classes that you can change, you can play around with the combination. We can reduce them, increase them, depending on what kind of time frame you're looking to trade. So 13, 21, 34, if you're trying to use three exponential moving averages, which I have essentially broken those three into two parts for as 5 and 8 EMAs and 13 and 21 EMAs. And on the charts, it will give you a feel like this, and this. Now I use them from the point of view of a short-term trend and the medium-term or the long-term trend, whatever you call it. And I call them T1, T2, the first trend combination and the second trend combination, based on which I have kind of created few trading strategies which are shared in my various courses. But essentially what I'm looking for when I look at these bands of exponential moving averages is the trend. So this is the Nifty daily chart, and I can see the first set of EMAs and the second set of EMAs. They are beautifully up, they are rising one on top of the other. It's a nice uptrend. This is a nice downtrend. And then when there are like situations where it is not well defined, I generally try to stay away from them because the trend is not very well established. So trend plays a very important role here. That's what I'm using. For the momentum, I like to use, I have a little unconventional approach here. I tend to use the 3-period RSI, and I plot the 3-period SMA of the 3-period RSI to kind of tone it down a little bit, to slow it down a little bit. And when I'm using a 3-period RSI, I'm using 75 as my overbought and 25 as my oversold, as 50 being the central line, right? So for a pullback trade, I generally like to see that in a downtrend, when do you bounce back? What is the extent of the bounce back? And when you're in an uptrend, when you're correcting, what is the extent of the correction? Do you go oversold, etc. or not? Divergences with price and RSI also plays a very important role. And when you find, or when you try to find such divergences, try to use the line chart, please. Try not to use the bar chart or any other. Always compare price and RSI when you're looking for either positive or negative divergences. compare with the line chart. Then you can bring your bar chart. Okay, by the way, I use bar charts. I like to use bar charts and of course Heiken-Ashi. So that's for the underlying momentum. And then volatility. I had made, I think, one video on this a couple of years back. It should be there in my YouTube playlist. Is this one wherein I am looking at from a very short-term perspective. All right, what is the average range ATR of particular one bar at a time? So one period ATR, and then I'm going to average it out with a 20 period and give it one standard deviation and two standard deviation. If you didn't understand what I just said, what I'm doing here is I've just plotted one ATR, plotted two Bollinger Bands on the ATR. For the first Bollinger Band, I'm using one standard deviation. For the second Bollinger Band, I'm using two standard deviation now. So what it gives me, what it helps me to figure out is I would always like to see or find my trade in a non-volatile quiet stage where my ATR readings are sub-average, below the 20 period average of itself. And yes, hopefully if it is below the one standard or even below the two standard deviation, it means that the market is very quiet, or that particular bar, the size of that bar or candle is very small, which means that I can expect a breakout. And on the other side, when the size of the ATR actually expands and shoots outside the average, or maybe goes outside the one standard deviation, or in extreme cases goes outside the two standard deviation, it means that a move has taken place either up or down. And this move is quite extreme. And if you have managed to ride this move, it's time that you book partial profits or book 100% profits or trail your stop loss aggressively, etc., etc. That you should be careful. You should not be holding on to this position for long. Quote unquote, all these tools are from a short-term trading perspective, right? So it helps me to pick up a trade, and it also helps me to figure out whether the move has kind of established itself or not. So there you go. And by the way, this is not a combination that I figured out 17 years back when I started, that okay, this is the combination and this is the golden combination. It has kind of evolved and emerged. And between all these, one aspect that I continue to work upon, research upon, try to figure it out in a better way is the underlying momentum. For trend, I don't actually work any further. For trend, a moving average combination is just fine. You can use anything. Trend does not alter so much, but the momentum is something that intrigues me a lot. Volatility, ATR is fine. You can use Bollinger Bands. For sentiment, advanced decline, VIX is also fine. I don't look at it so much that closely. Volumes, I would like to quickly talk about volumes. It's there on my charts. What I do is the volume histograms are definitely here, but I bring in a 5 period and a 20 period, especially when you're in a daily chart. This is a weekly chart of Nifty though. Let's say we go to the daily chart of Nifty. Yes. So I would like to take a look at the 5 period and 20 period, which is essentially a week and a month, right? You can change this. If you're in a weekly chart, you can change the numbers to 4 week, which is a month. You can keep it 2026, which is half of a year. So see, I keep it standard 5 and 20. These are just, these will give me a sense of what's happening. This is not going to help me. This is going to help me to take the right decision. It's not going to make me money, right? The decision is going to make the money. So what I would like to see, and you would have noticed that when a particular stock is about to break out, about to give me a big move, I generally have noticed that volumes dry down significantly. The volume bars are like this, falling. 5 period is below the 20 period. It's a very, very quiet market, which is like probably about to give me a move. When the move happens, when the market picks up a move, you always will notice volumes picks up. So I would like to enter the market before the move, of course, to ride the move. And that's why I look for situations where volumes are extremely dry, right? So here you go. I hope Code Learner and Prakash Radhakrishnan, you would find this useful. And as I was saying, that these combinations have evolved. It's not like it was given to me. And maybe it will evolve further without deviating too much from the structure. Okay, I might use a 3 period ATR. I might check whether And what I tend to do is at times when the market goes really volatile and it becomes really difficult to catch the market, I increase the periodicity of the indicators to slow down my signal. On the other hand, when the market is in a beautiful trend up or down, I decrease the periodicity of the indicators so that I make use of the underlying momentum. So this will come with experience. But without deviating from the structure, that is the elements of trend, momentum, volatility, etc. This is my approach, something that I have developed over the last 17, 18 years now, and it's worked good for me. I have been teaching this concept for many years, and I hope that it has, I know to some extent has worked for others also. So there you go. I hope you like the video. Do let me know. Drop out or just give me a feedback, suggestion. If there's something else that you're using, I'll be more than happy to learn from you. So with this, thank you for kind of pushing me, requesting me to make this video. I enjoyed making it. So take care of yourselves, trade well and trade wise.